We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Majeure. Just a quick note before we start this episode. It is quite long. We do go through a lot of definitions at the beginning. If you are comfortable with the terms in the futures markets, such as open interest, who the participants are, how all that stuff works, I still encourage you to go through it and learn it. But we get into manipulation and his thoughts around subjects like that around the 45-minute mark. Please let me know if you enjoy it. Thank you. Welcome to Palisades Gold Radio. I'm your host, Tom Majeure. Joining me today is Jim Hunter. He's a futures trader with 35 years of experience and currently trades with Allendale Incorporated. How are you today, Jim?
I'm doing fine, Tom. Thank you very much for the invitation. It's a pleasure.
Thank you. I really appreciate your time, and I want to give a special shout out and a big thank you to Nate Fisher. He's been on the show before, and he has the YouTube channel that's called The Financial Enthusiasts, and he set all of this up. He's the one that started discussing this with you. And he just ended up kind of running out of time this week. But this is a very timely discussion because we're in the end of June here. This is the end of the quarter. All of the silver contracts are either getting delivered or being rolled over, and that's what we want to talk about today. All about futures contracts, trading, open interest, all of those things. So, Jim, why don't we start our discussion around some definitions? So maybe let's start by defining, let's say, long and short positions in the futures arena.
All right. Futures contracts are leveraged derivatives, and they've got components that ensure quality, quantity, and a time component. And if somebody decides to buy a futures contract, they will also be known as a long in the contract. And if somebody decides to sell or be short a contract, they are synonymous. They can choose to sell a contract. You can do in a futures trading, you can do either or. It's not unnecessarily analogous to stocks where you have a naked situation. We don't really have naked in futures. That if you think that the price is high, you can start a futures account and sell the contract first and hope to profit by buying it back cheaper. Or if you think the price of silver is low in its price cycle, you can buy the contract first and hope to buying it low, if that's your opinion, and hope to make a profit by selling it at a higher amount later in the future. Within an hour, a week, a month, 2 months, you get to choose how much time you want to participate in, depending on which contract you and your broker decide you want to trade it.
Mm-hmm. So let's also touch on something you said there. Why is it that there are no real naked short positions, or there shouldn't be?
The position in the stock market of a naked short is defined as somebody that sold shares of stock that didn't own the stock. Okay. Typically in the stock market, you borrow a share from an investor and then you resell that share to somebody else. Okay. If you didn't borrow the share, the way the definition seems to be is that you are naked. You are selling a contract, or you're selling a share of stock that you didn't own. In futures, we don't really have naked. There's two time periods. One is before delivery period and one is during delivery period, when the price or the time period before delivery period, the trader, the long, may decide to stand for delivery, or he may decide he doesn't want delivery, and he will roll or cover his long contract by selling out, regardless of the price, before first notice day arrives. And first notice day, actually, by coincidence, is today. Started with last night's Globex trading at 6 o'clock Eastern time on Tuesday, which is the start of Wednesday's trade. So the term naked doesn't really matter or doesn't really apply in futures trading because it's a paper contract that you have an obligation, okay, before first notice day, you have an obligation to either stand for delivery if you're long or make delivery if you're short as the contract goes into delivery. But it's not necessarily so should you, as the manager, as the owner of that futures contract, either the owner of the long or the owner of the short, if you decide you do not want to make delivery, you can simply roll out of the contract into a further month, or just close it out and not trade anymore until you decide you want to trade in the future into a successive month. So the term naked, people will think it means, well, they don't have the metal. Well, the short, it all changes at delivery day. Okay, at delivery day, you can assume that the short has the metal to deliver, and you can assume that the long has the cash to buy, to receive delivery. So in delivery period, really, it's just a question of when the short decides to deliver to the long, and then the exchange takes place. Cash for physical silver, physical gold, cattle, oil, that whatever your contract you're trading is.
Mm-hmm. So I think another piece that's important to highlight there is that the short actually defines and decides when they're going to deliver within that delivery period. Is that right?
That is correct. One side has to determine when it gets done, and because the short has the metal, they're in control of the metal in the warehouse, in a COMEX approved warehouse. There are about 9 or 10 of them. And 2 of them are owned by banks, and one of them is JP Morgan. They started a vault, I believe it was in like 2012 or so. They got approval in 1 or 2 days, which was the industry kind of was in a little bit of surprise of. And the other one, I believe, is Hong Kong Shanghai Bank. And the other ones are for-profit warehouses, not really tied to a bank. But the short has the silver in there, in the approved warehouse, and when he decides to deliver, he instructs his brokerage company to deliver on this date in what's called T+2, the trade date plus 2 days. That lets the other side, the long, lets his broker tell the long that the silver will be coming in 2 business days, and his account is fully funded. And then at that +2 day, so if today was day 1, all right, +2, T+2 would be Friday. Friday, the long's money transfers to the short, and the short's silver transfers to the long, and the delivery process is concluded for that particular contract.
So what would be the procedure if the short did not want to deliver into their contract? Or would that be considered rolling over?
The short can do one of 3 things, okay? They can deliver, or they can deliver during delivery period. And your question is, what if they choose not to? In delivery, before delivery period, they just buy their futures contract that they are short. They buy it back in the COMEX trade. In delivery period, if they choose not to deliver, they just, before they deliver, before they issue the T+2 to the counterparty, to the long, they just say, all right, I've decided not to deliver this time. So they go into the market during the July delivery, if you're using this month as an example, and they just buy back the contract in the trade time. Trade time is between 6 o'clock the night before till 5 o'clock today. So last night they trade 23 hours, except for Saturday. They don't trade Saturday. They end futures trades end at 5 o'clock on Friday. They open again on Sunday, although this weekend is a 3-day weekend, and those hours may be adjusted somewhat because of the 4th of July weekend. And then the other thing they can do is they can deliver them. So the short has a couple of ins and outs. The in would be to deliver. They have a couple of outs either before delivery period or during delivery period. And the short also gets to decide if they can cover their current July contract. They can immediately go to the September or the December contract if they choose to, or they also can say, the price seems a little bit low in the recent price range. I'm going to wait until the price rallies before I sell again. But the short, there's 4 to 7 or 8 large bullion banks that may be short on occasion. And the reason they may be short on occasion is because they have contracts tied to mine production. And if you kind of figure that there's 800 million ounces of mine production that happen each year on an annual basis worldwide, let's say that these 3 to 5 to 7 bullion banks have contracted, let's say half of it, 400 million ounces per year. So they've got a natural inflow, contracted inflow to come in to their possession, okay, and they need to move some of that silver out, and they can move it out at their respective, convenient time. If the price rallies, it's a natural time for them to be short more contracts in volume because they like the higher price, because their price that they negotiated with those mines, that deal is already done. They're in possession of the metal now, and they don't pay the mine retail. They negotiate a price, and they're not getting not 0.999 silver from the mine. They're getting a Dory bar, which let's say it's 85% pure. All right, so it gets refined, it gets stamped into a good delivery bar that's at or near 1,000 ounces, and then it moves into the possession of the bank, of the bullion bank. Either if it's JP Morgan, it might be at their own vault. If it's Hong Kong Shanghai Bank, it might be at their own vault, or it might be in somebody else's vault. It really doesn't matter. But it's really the choice of the short and also the long, Tom, to decide to make or take delivery, or to just cover their contract by offset, by doing the opposite position in the futures market. Or the other idea would be or the other option is they buy back the one that they're short and they resell. So they would roll ahead to the successor month. That month might be, well, we're in July now. It could be August. It could be September. It could be December. We do trade every month. The bullion banks have the right to deliver metal in each calendar month of the year.
So, Jim, when we're talking about where let's say these future exchanges are happening, we've mentioned the COMEX. Which other exchanges are we talking about here? Just to clarify.
There used to be separate ownership. Each exchange used to be owned by what was called seat holders, the people that bought memberships, and then they would either themselves or their staff would go into the pits and they would wave with their hands. They would do trading. This means sell. This means buy. Palms in, or they want contracts, and then they would do fingers, kind of a sign language, their own professional sign language. Well, with electronic trading and computers, that kind of changed, Tom, maybe in the last, I'd say 15 to 20 years. And one of the exchanges, the Chicago Mercantile Exchange, commodity exchange for meats and currencies and the like, they decided to start buying some of the other exchanges up. So now most of the exchanges, which would include the Minneapolis Grain Exchange, the Chicago Board of Trade, the COMEX Exchange. There's an ICE, or an international commodity exchange. There's a Winnipeg Commodity Exchange. There's a London Metals Exchange. There's exchanges, in different countries. The main ones in the United States, it's typically going to be a CME or Chicago Mercantile Exchange owned exchange. But they are separate, like the Board of Trade still trades, that's still where the grains are, but it's not the same Chicago Board of Trade that it used to be when you had the people that were the pit traders were the owners of that seat. I believe the Chicago Mercantile Exchange is a public company that you or viewers, listeners can own stock in if they think that it's a growth industry. And I believe it's been public for over 10 years. Mm.
But for the purpose of, let's say, the metals, we see Hong Kong, London, and New York. Is that correct?
I believe that's right.
Okay.
I believe that's right. And the big one seems to be the London over-the-counter market. Mm-hmm. Okay. People talk about, that the tail of the dog is wagged by the COMEX traders. But from the way I understand it, there's a gentleman out there that's very sharp and very involved in it. His name is Andrew Majeure. And he is a London trader, and he knows more about London. I know very little about London, about the over-the-counter market. That's kind of a commercial or a big high net worth investor calls in and talks to somebody like Andrew Majeure and negotiates exactly how much they want at what time in a day, in 2 days, in 5 days. Futures contracts are different. They've got a fixed time component. They've got a fixed, in COMEX Gold, it's 100 ounce. It's a fixed 100 ounce contract. Mm-hmm. There is recently a 400 ounce contract that is not getting legs. It is not a highly traded contract. And in silver, it's a 5,000 ounce contract. It means 5 1,000 ounce good delivery bars They're not exactly 1,000 ounces. They're plus or minus an ounce or two. But and then there's also a mini or a micro contract that's 1,000 ounces. And viewers or listeners, they can trade the 1,000-ounce contract, but it's way down in volume and liquidity. So you pay a little bit more for, you'd rather trade one large regular 5,000-ounce contract than 5 minis. It would save you commission costs, and you'd actually end up getting a little bit better price.
Mm-hmm. So when we were talking about rolling a contract forward, Jim, how much would it cost somebody that has that short position or the metal to sell? How much does that cost them to roll it forward to the next delivery date?
There are for the John Q public. Okay, I want to speak about John Q public people that might be your viewers or listeners first. They typically have 3 fees. There's a commission to buy and sell. Okay, and in our particular business, we charge half the commission when they buy and half the commission when they sell a futures contract. If they do an option, the option commission is charged up front because a lot of options expire at 0. They expire worthless. All right. The second fee is an exchange or transaction fee, and that might be a couple of dollars to maybe $4. It's not quite the same. The grain contracts transaction fee is a little bit less than the New York platinum or gold or silver transaction fee in most cases. And that might be, let's say $4. Let's say $4. $4 when you buy it, $4 when you sell it. That covers the infrastructure. The exchange gets a piece of that. The CME owned COMEX gets a piece of that. Might pay for back office help at the brokerage company. And then there's an NFA, National Futures Association regulation fee. And they charge 2 cents a contract, Tom, when you buy the contract. And when you cover or roll it, they charge another 2 cents. So it's in total 4 cents for regulatory fees from the National Futures Association. Commissions, if you are a seasoned investor, you don't need a lot of help, and you trade many contracts at a time, you can negotiate your commission with your futures broker. And there are you can look up online brokerages if you futures commission or futures traders, if you want to trade online without the help and the guidance of a human commodity broker. And those commissions, you are likely to pay a little bit less than having to pay for the manpower to help guide you, give you trade ideas, trade histories, trade research, and the broker has to get paid. So using a broker, a human person, you're probably going to pay a little bit more. I would say that if you trade with me, you can be all done for buy and sell for about $85. Okay, it might be $85.04. It might be 2 cents to buy and 2 cents to sell.
So what would it cost for an entity to roll forward to the next month, Jim?
Okay, so if you use an example, all right, let's say that Tom's futures account, your futures account, bought a contract of July silver, and let's say you bought it in the first part of May. And let's say you bought it for $26, and we come now to first notice day, which was today. You called your broker, if you're using me, you called your broker and say, I don't want to take delivery, so I want to roll my contract. And the broker would ask you, which contract would you like to roll it to? Would you like the higher liquidity contracts after the July would be the September silver or the December silver? So the broker might ask, Tom, which contract, how much time do you want to be involved in? And Tom says, all right, let's roll it to the September. That'll give you from the end of June, that'll give you through July and through the end of August, because first notice day for August will be, or for the September contract will be the last business day of August. So that gives you 2 months to make a profit. So we enter an order that says, sell, Tom is long one contract. So we would enter an order that would say, sell 1 July silver, buy 1 September silver. Okay, and automatically that trade gets done in the exchange, in the COMEX exchange. So let's say that for all practical purposes, you bought it at $26 and you sold it at $26. All right, so the July contract, you didn't have a gain, you didn't have a loss, you had a commission. Okay, in answer to your question, if you were trading with me, it would be half a commission plus a transaction fee plus half the NFA fee. So let's say If your fee was $80, it would be half of 80, that's 40. It'd be one transaction fee, let's call that $4, and it would be one NFA fee of 2 cents. So it'd be $44.02. Okay, that's what you paid to get out of your July. It would also be that same exact amount. It would be $40 plus $4 plus 2 cents to buy that September at the same time. And that bought you another 2 months of trade that you've got exposure to the silver to hopefully get out of the September silver at a higher price than what you paid. Now, there's one other incidental that people should be aware of. It's not likely that when you're selling a July silver that you're going to get the same amount that you're paying for the September silver. And the reason is that we don't charge interest. Okay, when futures are a leveraged item, okay, we don't charge interest, but the interest is basically impacted in the next futures month. So the September contract might be 2 or 3 cents per month more per contract more than the July that you liquidated. So let's say you sold your July at the same price you paid for it, $26. You may have bought the September contract for, let's say, $26.05. So then your basis is now in the September at $26.05. You would make a profit at $26.06 or $26.10 or $27.05, something like that along those lines. So that covers rolling to the next contract.
Would that also basically the exact same framework apply to somebody that had the short position or the metal to sell? It's exactly the same. However, the person that is short, if they don't have the metal to sell, they absolutely have to cover their position as we approach delivery period. If the person that was your counterparty that they were short and they have the metal, they get to make a decision if they want to stay short into delivery period. Right.
If they want to stay short into delivery period, then there you can pretty much count on that short will be delivering metal, not to Tom because Tom rolled out and maybe Bill bought Tom's contract on the day that we liquidated. We would have liquidated it yesterday before the close to ensure that you weren't delivered on or before.
Let's go back to a couple more definitions, Jim. What when we look at a COMEX report, what does the deliveries columns include?
Okay, if you look at a delivery report, you're going to have a list of banks, of the approved warehouse banks. And in each bank, you're going to have what happened for the day in their respective warehouse. Okay, and each short isn't necessarily, like I mentioned before, Hong Kong Shanghai Bank and JP Morgan are two banks that have their own warehouse, but they may also have metal in somebody else's warehouse. And how might that be? Because, for instance, JP Morgan recently, including today, have been stopping contracts. All right, so they're stopping contracts, meaning they were long futures and they got delivered on those long contracts, but that metal might be in somebody else's warehouse other than their own. Okay, they have the right to leave that metal there, or they have the right to move that metal to their own warehouse, to their own bank vault. All right, so what you're asking is there will be two components of the warehouse report. There will be today's activity from yesterday in either a column called eligible silver stocks or registered silver stocks. And then the final column will be the summation of the difference between what happened yesterday to today in both of those categories. Now, there may have not been any change, and you will see that day after day that there aren't many changes, and yet there might be some banks or some warehouses that have changes because somebody, maybe a bank, a bullion bank, received a shipment of silver from a mine that day, okay? And that may go either into eligible or into registered, and it's the owner's option to register it if they want to, or just to put it in eligible if they want to. The only difference between the two categories is what's called a warrant. And the warrant allows that silver to be delivered. It's the same exact silver, the same 5 1,000 ounce bars per contract, but the warrant determines if that's going to be classified as eligible stocks, which it wouldn't have a warrant, or if it has the warrant, it gets classified as registered stocks for that particular bullion bank.
So if it's eligible, it cannot be delivered?
If it's eligible, it can be delivered if the owner decides to attach a warrant to it later today or tomorrow or next week, which is their prerogative. They get to choose.
Which then changes it to a registered?
It changes
contract?
it to a registered, and that can happen in 5 seconds.
Okay.
They can say, all right, I'm deciding to deliver metal that was ineligible. And why might that happen? That might happen because maybe during delivery period, an unexpected number of contracts starts fresh. Other than that, I think I said there were 7,700 contracts as of last night eligible for delivery. That starts first notice date today. Well, maybe later this month in the delivery period, in the month of July, maybe 3,000 more contracts. I'm not saying it's going to happen, but maybe 3,000 contracts additional decide they want metal in July. And why might that happen? Okay, it might happen because somebody inherited some money, or somebody gets to somebody big, a big high dollar net worth person, and they convince them that silver is the best investment going. Okay, or it's a low risk buy at this price at $26, which I personally feel it is. All right, so if a new customer, a new client comes in and buys more contracts during the delivery period, if that bank, that bullion bank, is their counterparty short to that transaction, but they didn't have enough contracts in their registered stock or registered silver category, they can easily take more out of eligible and make it registered, however much they need to do within a few seconds of time. So the eligible is a deliverable type silver. It's all set to go. However, it's held back because it does not attach. It does not have attached the title, if you will, the warrant, like a title to your Ford pickup truck or your SUV. It does not have that title attached when it's registered as eligible at the end of any particular day.
Right.
And if you look at I think we attached a link at the end of this interview. If you look at the report, you'll see there's an eligible, there's a registered, and then there's a sum total for each of the warehouses. Mm-hmm. There's like 10 of them. And it's a matrix. You can watch it from day to day. And some faithful followers on Twitter do watch those eligible and registered stock changes.
So, Jim, what does open interest mean? And this is particularly important right now because we've seen over the last day, basically, that open interest has basically crashed. Like it has gone down fairly dramatically. So explain to us what open interest means. Open interest,
it's just the sum total of one long and one short contract of a futures contract. And if you want to take an example of July silver, okay, if Tom is a brand new customer and he decides to buy a contract of July silver before, let's say before delivery, before today, okay, if he's buying somebody else's contract at the exact same time that somebody is selling a July silver contract, okay, then the open interest would not change. You've assumed somebody else is long. However, if you are buying a contract of July silver and nobody else is selling at that particular moment, at that particular moment closing out, then you bid and somebody hit your bid with a sell, that creates a new contract. So Tom has one new contract and a short has one new contract. One long and one short of a new contract increases open interest by one. Okay, so open interest, it's basically a simple definition of the number of shorts and the number of longs at the end of the trading day in each contract. So the July contract has an open interest, the September contract has an open interest, the December contract has an open interest, and they sum total those. And that link of open interest, I believe, has been sent to you to include at the end of our presentation. If people want to watch open interest change day to day, week to week, they can make notes and watch it.
Mm. So if there's a matching short and a matching long, that does not go into open interest, correct?
Well, the open interest stays unchanged if your buy, when we decided to buy a contract before today, before delivery period, mm-hmm. okay, if you are buying somebody else's long, okay, and you don't know if you're buying somebody else's long, and you don't know if your new contract is going to increase open interest by one or not. And it really honestly doesn't matter to you. It matters a little bit more in delivery because people are watching. They're trying to cross the amount of open contracts the first notice day of delivery to make sure there's some conspiracy people out there that think that the COMEX is days or a couple of months away from defaulting on delivery. And I don't see it that way at this point. It may change in the future. But the open interest for Tom for a 1 lot or a 2 lot, it really doesn't affect things, that much. Whether you're buying 1 or 2, it doesn't matter if the open interest goes up by 1 or 2, or if you bought somebody else's contracts from another long that was liquidating. So that would have been, let's say, Jane was liquidating 2 at the same time Tom was buying 2. If the COMEX exchange crosses your buys with Jane's sells, the open interest stays the same. If Jane wasn't selling at the same time you were buying, you're buying 2, a short just hits your bid and they create 2. So the open interest goes up by 2. It's not a big deal for 1 lots, 2 lots, 5 lots. It's a bigger deal if you've got a larger trader trading 1,000 or 2,000 contracts at a time. That can affect things more seriously than 1 or 2 or 5 lots from a small speculator trader.
So considering right now that we're in the delivery period, Jim, something that we've heard on this show and we read about on the internet is a shadow contract. So what is a shadow contract as you understand it, and walk us through what your understanding of it is? Okay.
As some people are talking, as you say, on Twitter or in different chat rooms, that kind of thing, a shadow contract will happen during the delivery period. And the delivery period is it's approximately a month long. It's a few days short of a month. Okay. And in February, it's a little less because, February is a shorter month except for an election year. But a shadow contract might be that somebody calls or starts talking with a high net worth individual, and he convinces that individual that silver is cheap at this price, or it's undervalued, or it's set to go up because we've come down from $30 a couple of times in the last several months, and we bounced off $24, $25, and it might be on its way up now from the lower amount. So if that high net worth individual decides that they agree, they open up a futures trading account, brand new, or it's an existing futures account, and they decide within the delivery period, they say, all right, I'm going to try my luck. I'm going to buy some contracts, and I'm going to see if I can buy it near this $25, $26 time price point. And let's just see if I can make that work for myself in the next 2 or 3 or 4 months. So they enter an order with their brokerage, with their futures broker or their online broker, and they say, I'm going to buy 10 contracts of July silver. And let's say that happened today. Okay, first notice day started today. But last night, coming into first notice day, we had 7,707 contracts left standing for first notice day. All right. So if that person, let's say that no deliveries happened today, and let's say that person bought 10 today, 10 new contracts, well, then we would add 10 to 7,707. We would have 7,717 contracts instead of 7,707. And somebody would say, a person watching for these shadow contracts would say, I've identified that open interest went up during delivery period. Where did those come from? Well, they came from somebody that's trying to identify an opportunity because they like the price. They might want to have the physical silver now, whereas if they buy an August contract or a September contract, they don't really have the right to stand for delivery until another month or 2 months in the future. September delivery will start the last business day of August. Okay, so they can buy it now, the last business day of June, or the first business day of July, which is tomorrow, and that open interest magically went up rather from the amount of open interest that was left standing at the end of yesterday's trade. So the visibility wasn't there on the first notice day, the 7,707. Somebody added 10 contracts of silver. Magically, it's 7,717. Their 10 contracts came from where? It came from somebody that wanted to be long in the delivery period. It's not a big issue. There's no, witchcraft or voodoo, calling it shadow. You can call it whatever you want to. It's just somebody that entered into a new transaction, a new buy, and that was crossed by a seller, by a short, in the delivery period. So it increases open interest, although a lot of times you might see if there were no deliveries that day, the shadow contract increased the open interest. If there were deliveries that day of 300 and somebody bought 10, then the open interest only went down by 290. The difference between the plus 10 and the minus 300. The minus 300 is 300 contracts getting delivered.
So, Jim, in our pre-discussion for this interview, you told me that there's basically three types of traders that exist in the futures realm. So, can you explain to us what those are, please?
Yes, sir. One trader. Let's start with the biggest. The biggest trader is likely to be a bullion bank. Okay, and they are typically a short in the futures business because they have supply that they need to sell. And they get supply because they have a relationship, a business contractual relationship with one or two or several silver mines or gold mines or oil companies, that kind of thing. So the bullion bank plays a part that they supply cash to a miner that supplies silver, and it's a trade. It's a simple exchange. The bullion bank makes money by buying the silver from the mine. The mine makes money by selling the silver to the bullion bank. All right. So that's one trader. They tend to be short. Okay. They don't have to always be short, but they tend to be short because they're going to deliver the metal that they receive. If the sum total of all the bullion banks is getting 400 million ounces, per year annually, half of the 800 million that's being mined, they've got a project to offset that silver for cash, for money, for profit through the futures exchange. So that's one type of trader. They might be a natural short. All right. Another large trader might be a natural long. And that might be somebody that owns an EV, electrical vehicle company, or an aerospace company that needs the raw silver to use in industry in their products, whether it's a guidance system for a missile, a cruise missile, or whether it's for solar panels for their production, or it's for, I don't know of a jeweler large enough, but it might be a consortium of jewelers that buys their physical silver and their physical gold from an entity, from an intermediary that takes possession of the gold or the silver from the COMEX exchange through delivery. All right, so you've got a natural short in the big bullion bank. You have a natural long, and you'd call that a commercial hedger, and they might be long because they're a user for the end product. And then, Tom, the third type of trader can be a very large trader, or it can be a very small trader, and we'd call those a speculator. And there can be large speculators, and that might be a hedge fund. It might be a CTA, which is a certified trading advisor, a futures certified trading advisor, or a pool operator. He pools yours and mine and Smith and Jones and Johnson's money together, and they decide to go long or short. Typically, a certified trade advisor or a pool operator will go long or short. Or there are long funds only, or there are hedge funds that go long and short, depending on how they see the trend of the underlying. The underlying would be the futures contract on silver or gold or copper. And I will say that there have been some great big moves in some of these contracts. Lumber is a big one. Coffee is a big one. There have been some great big moves from last year. Crude oil was a big one. And so the speculators, they take on risk against the hedgers that are off laying risk. So the hedger, his job is to buy at a price that protects their margin. If they are a long hedger, a short hedger might be somebody that needs to sell the futures contract to protect their price from the price going down. Now, I can give you an example of one trader that would do both. Okay, and that might be somebody like ExxonMobil Company. ExxonMobil Company drills crude oil out of the ground. Okay, and let's say they drill it out of the ground for $40. That's what their cost is, but they've got general and administrative expenses, and they've got overhead. So let's say that costs them $50 per barrel. All right, they can go to the futures exchange right now and hedge that oil. If it's over $50, they're making a profit. Well, the crude oil now is over $70. All right, so they're a sell hedge there on the crude oil to make sure that the price of crude oil doesn't go down. And then one of their Exxon gas stations, That might be a company station, or that might be a franchise company that owns that gas station. They need to protect themselves from the price of gasoline, the end product from the crude oil, from the gasoline going up. So they might be a buy hedger or a long hedger. So under the auspices of Chevron, they need to protect two prices. They don't want the gasoline to go down. They don't want the crude oil, or they don't want, the gas station doesn't want the price to go up. So he protects himself with a long hedge. And the Chevron company doesn't want the price of crude oil to go down. So they protect themselves with a short hedge. So that's the hedger side. That's number two trader. The number one trader was the bullion bank. And they're a natural, like Chevron in part. They're by definition, they are a physical long. They don't want the price of the silver to go down. So they would be a sell hedge. Also, that sell hedge on their physical inventories, protecting them from it going down. But it also, through COMEX, enables them to deliver metal that they are short during the delivery period. And then the third trader, again, the speculator, can be a large, a middle size, can be a short. It can be somebody like me or somebody like yourself or your uncle or a friend of yours. They may be a one lot trader, a 5 lot trader, a 50 lot trader. A 50 lot trader in silver is a pretty big trader because the margin's $15,000 a contract. But in corn, it's $2,400 a contract, something like that. Soybeans are less than 5,000. So people have a multitude of futures to research and to decide where they want to trade. But if we're talking about metals, silver in particular, you might have some hedgers, long hedgers, short hedgers, and then you've got what's known as speculators to round out the three types of traders.
So when we began this discussion, Jim, you were saying that that this is a leveraged contract, and you were just talking about trading on margin, right? So
yes, sir.
Explain that to us and explain why margin requirements really change from time to time here.
Okay, the margin, you're hitting on the fundamental reason why a futures contract works. And that is because through the auspices of setting up futures contracts, somebody decided in their wealth of wisdom, which it's the key to how a futures contract works, they decided to charge a margin, a good faith margin deposit. It's not a down payment. It's respectively, it's a good faith margin deposit to trade either long or short. Okay. Now I will say that the margin varies a little bit if you're a commercial. The commercial is typically known to be more in touch with the contract, so they're a little less risky than a speculator. So the margin for a commercial, it will be a little bit less than the margin for a speculator. All right. But let's talk about silver. The futures margin to trade one contract of silver is, let's call it $15,000. Okay. At $30 silver, that $15,000 margin is 10% of the total contract value. At $30 silver times 5,000 ounces, it's $150,000 of total contract value, or 10%. Okay. Currently, it's about 12% of the margin. And the margin is required by the buyer and the seller from each commodity brokerage house. We use R.J. O'Brien, that's our futures commission merchant, and they will not let you get in the door without customer paperwork that lets them know their customer and without margin deposit money or margin money to affect a trade. All right. So the margin is a function of the volatility, the recent volatility in the underlying contract. And silver has had a series of margin increases over the last several years. It used to be $5,000 margin several years ago, maybe 8 or 9 years ago.
Per contract.
It was $3,000 per contract. But if the silver for years, if you go back and look at a chart after 2011 and before 2020, the silver kind of traded in a range. It was range bound. So it's not a function of the price of silver, the margin. It's a function of how quickly the price changes. That's another name for volatility. All right. So if the exchange, not the CME, okay, if the exchange decides through their computer risk management system that the margin needs to be increased, and the reason for that, Tom, would be a sharp increase in volatility recently, either in the last day or two or the last day or three, it wouldn't be from 3 weeks ago. They will issue a margin increase, and it's typically the day of the increase, it affects the buyer and the seller, the long and the short, at the end of that business day. So at the end of that business day, if the margin went up, instead of $15,000 now to control a silver contract, it might be $16,000 or $17,000. It might go up by $1,000 or $2,000. Will it go back to $15,000? It will. It will if the volatility settles down in the near future. Now, the reason we have margin, as I started out to say, is because the margin deposit, it emphatically means it's the way that the losing side pays the winning side at the end of every trading day. So the money physically transfers from the short to the long. If the price went up or if the price went down, the money transfers from the long to the short from their margin deposit sitting in their brokerage account at the end of every business day, at the end of every trading day. So hence the reason the margin requirement is so important. And if the margin, let's say the margin on silver was still $5,000 right now, and we had a $3 move in silver. Can we have a $3 move? We can in 2 days. It's happened in February, both up and down. All right. So that $5,000 margin isn't enough now to cover the liability from the loser of that $3 move in 2 days or 3 days. Gold had a $60 or $70, $68 move, and they had a $40 move. Well, a $40 move in gold is $4,000 a contract. It's $100 a dollar. So, I mean, it can really add up. And so the exchange, the brokerages, they are in favor of the margin changing when the volatility changes, because a little secret, if the customer doesn't pay, the brokerage has to pay to ensure the integrity of the market. The brokerage company stands behind the trader. Okay. The trader needs to pay, but if they don't pay, the futures company will start court proceedings, and they will, take them to court to make them pay in the future. So the margin is very important, and it is subject to change depending on the number one factor, volatility.
Mm-hmm. So Jim, now that we really have a really good understanding of how all of this, let's say, framework works, where do you think that there is manipulation in the market, or do you think that there is manipulation in the market?
I do, Tom. I think that in my career, I've seen it several times, and one big time was when rules were changed against a couple of brothers and a sister that were trading silver from the long side in 1980. The exchange changed the rules against these people to a liquidation only order, meaning they couldn't support their own account by buying more. Okay, they were up big in profit, and the exchange changed the rules. I think that is unfair. I don't think that is right. There were rumors that some of the people that had a voice to change the rule were on the other side of the trade, meaning they were losing as these two brothers were making money on the upside. All right, so that's one instance. Another instance is people talk about early in the morning or on a Sunday evening when there's very little liquidity, that the gold market or the silver market gets sold off by several dollars, not silver several dollars, but gold several dollars. Let's say $5 or $7 or $9 in an illiquid, if you will, a non-daylight hour. It's daylight for London when it's 6 a.m. here, but somebody forced those trades through, and somebody might suspect that they are looking for stop orders, open stop orders, stop loss orders to protect an investor that's long from losing too much money. Well, if an entity enters a bunch of orders and those stop loss orders are hit and the price continues to go lower, and then that entity that started selling starts buying back their shorts in a few moments, let's say it's 3 minutes or 12 minutes or something, they've effectively increased their ability to make a profit by causing the market to go down. And I very much want to stress that, in my opinion, Tom, that's manipulation. It's manipulation because I think it fits this definition to a T, that somebody caused an action or a reaction to happen, and because they caused it and then they benefited from it, that, in my opinion, is textbook manipulation. And that I don't know the number of times it happens in a monthly basis or on a yearly basis. Let's say if it happens twice, it's 2 times too many. So I would say that that's manipulation. Okay, that somebody in an illiquid time caused a market reaction, caused the price to go in their favor so they could benefit. It's not supposed to be that way. People are supposed to respect the right of the public, of their fellow traders. They're not supposed to cause issues that change the price. And people are supposed to react to the price. They're not supposed to cause the price to change. So in my heart, I believe that's manipulation, plain and simple. And that has happened. There's a gentleman in the industry that watches it closely. His name is Mr. Butler. He watches it closely, and he has been preaching truthfully and rightfully so, in my opinion, that one big bullion bank in the last 12 years, since like 2008, 2009, in the last 12 or 13 years, affected price changes on the futures exchange so they could make money in their short positions, and they could also start buying physical positions of silver. And I would consider that a manipulation as well. Okay, so that's a couple, 3, I guess, definitions or instances where Jim Hunter would say, we have had and seen manipulation in our futures markets. I'm not a lawyer. Those examples might be better served, or questions might be better asked of a securities exchange or a futures exchange attorney. But the way I understand it, my ethics training, that if they caused something and they benefited from it, that's textbook manipulation. We can go on to the next one.
So in our discussion, you were saying that when they're trading at these illiquid times of day, it might be, let's say, somewhat unethical, but it's not necessarily illegal, right?
Well, I would say that if it's manipulation, it's illegal. But I will say that our exchanges are open. We open at 6:00 p.m. on a business day, and we close the next day at 5:00 p.m. Okay, so they're open 23 hours a day. There is not anywhere in the rule book that says a trader is restricted from selling 100 shares or buying 200 shares or something like that. The exchanges are open and things happen, and if somebody is saying to themselves, I need to sell these contracts, for whatever reason, they can have a reason. And if it's 3 or 4 contracts, that's not manipulation. A 1 lot, a 2 lot, 5 lots, 10 lots, that's not really going to move the market. But if it's 300 contracts or it's 500 contracts, or let's say it's 1,000 contracts that the person enters in order to sell at 4:30 in the morning, New York time, 4:30, when I'm sleeping, you're sleeping, everybody in America is sleeping. London necessarily isn't. It may have been a London trader. It may have been a London office of a big bank, big bullion bank. They're worldwide. I don't know that. I don't know who it is because people trade with account numbers. They don't trade with HSBC, Hong Kong Shanghai Bank Corp. Okay, HSBC. All right, we don't know. In the old days, they were in pits, and you could see that the HSBC guy was coming in, and you could tell if you watch the movie Trading Places. You watch the guys come in, and they knew who they worked for, so you could tell who was buying, who was selling. Mm-hmm. Now it's more or less electronic trading. So the footprints are harder to find, but there's a commitment of traders weekly, and there's also the first Friday of every month, as long as it's not a holiday, we get a bank participation report out of the COMEX exchange as well, the CFTC report, and that will tell who the large banks are, American, US banks, as well as foreign banks. It will tell their positions on that given day per month. And there's a gentleman, Ed Steer, he covers that, and somebody can look up Ed Steer and subscribe to his service and monitor that through Ed's homework and research.
Mm-hmm. So, Jim, how about the idea that there are more claims, let's say more paper claims to a physical contract of silver than actually the amount of silver that exists?
Yes, sir. That really doesn't hold water for somebody to say that, okay? Because by definition, as we talked about, one open interest is one long and one short, and it matters more in delivery period than before delivery period, because in delivery period, you're pretty much required to have the silver to sell, to deliver, or you're required to have the money to buy to receive delivery. All right. But before delivery period, basically all bets are off, and you might have, let's say, for the amount of silver in the registered category, you may have multiples of that before delivery. It doesn't really matter, Tom, because that contract cannot be delivered outside of the delivery period. Mm-hmm. So I guess somebody can make a big deal out of it, that they might say, total open interest. That's what they'll quote, total open interest. But total open interest has no basis in fact, because September, October, November, December, January, February, next year's March silver has nothing to do with the registered stocks in the COMEX. The registered stocks in the COMEX equate a little bit more to the current month, and especially more when it's in delivery. Mm-hmm. So people will talk about, well, the total open interest is so many millions of ounces of silver. It doesn't matter because only one contract comes for delivery at a time. So right. I guess I would say the people are welcome to that opinion. They're welcome to have their bias that there's way more silver contracts in existence than there is metal. But they should really narrow their bias to the current July contract. That's the one that's up for delivery now, with the amount of silver that's in the registered. Also, don't forget about eligible, because eligible can easily become registered. Right. And in my opinion, my informed opinion, there's no reason to worry for this July contract at the current time. There's not enough open interest in the July contract standing for delivery to eat up the silver that's available in the registered category of the COMEX warehouses.
So as we see the volatility in silver, Jim, what does the price of the US dollar have to do with the price of, let's say, silver or gold? After the FOMC meeting, we saw the dollar appreciate and we saw both gold and silver go down. So what does that have to do with the price of futures contracts?
It's a very good question. And the dollar is basically goes up and down by announcements, by news, but it also changes if the rate of interest, specifically the 10-year US Treasury, if that rate of interest goes up, that will support the dollar. And that is because worldwide right now, Tom, there's many, many millions or billions or maybe trillions of government paper that's yielding very low or no or even a negative interest rate. I can't understand negative interest rates personally. I wouldn't invest my money in a bank that they charge me to store my money there, but that is happening. There's some, and especially if you equate real rates of return, which factors in the inflation rate. So you are 100% right that the value of the dollar affects the value of the precious metals that have got a component to them, gold more than silver, although people will argue that silver was a monetary metal before gold was thousands of years ago. But there's a very intelligent, well-informed brainiac man whose name is Jim Rickards, or James G. Rickards. And the way I would explain it is, if you take a teeter-totter at the current amount, at the current level, and on one side is the value of the dollar and the other side is the value of gold. And as the value of gold moves, typically so does the value of silver move. So his opinion is that the price of gold is just a pseudonym for the value of the dollar. As the value of the dollar goes higher, the price of gold decreases or declines slightly. Mm-hmm. And we will see that on these meetings that you talk about, FOMC meetings. We will also see it. We're going to get an unemployment report Friday morning at 8:30 Eastern time. It'll be 7:30 Central. It'll be 6:30 your time where you are. And that jobless and unemployment report are notorious for affecting the value of gold and silver indirectly via the US 10-year rate. If we get a very popular report, the value of the 10-year rate might go up a little bit, and that might cause the value of the gold and the value of the silver to go down a little bit. People should watch it at 7:30 Central, 8:30 Eastern Daylight Time, and they can just watch it for themselves if they want an easy way to watch it. Fox Business on your cable channel covers it almost exactly in real time when it comes out at 8:30 Eastern Time. that jobless and unemployment report. They come out one right after another. One is the jobless, how many new jobs were either made or lost in the last 30 days. And the unemployment rate is just, did the unemployment rate fall or increase? And if it fell a lot, and if the job report increased a lot, you are likely to see a decline or an increase, respectively, one in the dollar and one in the price of gold. They may not show the value of the dollar, but they may show the 10-year interest rate. And today, as I recall, the value or the interest rate on the 10-year US Treasury was approximately 1.47%. Mm-hmm. So call it just under 1.5. If that goes over 1.5 on Fridays after the reports, that's going to support the value of the dollar. And it's likely that gold and likely silver in tandem with gold may sell off slightly. Now, maybe we sold off in gold and silver recently. They've been going down the last week or 10 days. Maybe we've done that. I believe they closed higher today. So maybe we've done that enough to kind of factor in the jobless report that's coming. I would encourage your listeners and viewers to watch it for themselves. And Fox Business does post the front month silver contract and the front month gold contract. It runs on their scoreboard from right to left in conjunction with the NASDAQ index, the S&P index, currencies, and other futures contracts, things like that. So they can watch it themselves almost in real time, almost exactly as it comes out at 8:30, 7:30, 6:30, depending on what time zone they're in.
Perfect. So, Jim, have we addressed most of the places that you see misinformation or a miscommunication in, let's say, the Twitter sphere or wherever you want to say it is?
I think so. I think I'd like to add one more, Tom, and that is that I think that there is either some misinformation or some lack of knowledge in that a futures contract is similar, in my opinion, it's similar in delivery period. Okay, when somebody is standing for delivery, it's similar to somebody that might invest in a trust like that you have in Canada that takes people's money in and allows them to participate when the price of silver increases or the value of their share price or trust share decreases if the price of silver decreases. That's not unlike a futures contract before delivery. In delivery, okay, things change, and they change for the better. Makes it a little easier for somebody to understand if they're a Twitter follower, that there's one long and there's one short for each 5,000 ounces of silver and each 100 ounces of gold. So it's very much an allocated, if you will, if that's the right term to use. We don't use it in futures, but there's a claim on that 5,000 ounces by the long from the short, and the short has a claim on the money because on the value of the cash, because they constituted a deal. They did a trade at some point before the delivery or even during delivery period. And then the short decides, all right, I'm going to transfer my metal to you. Title to my metal, okay, is going to go to you on this T+2 day, the day that I informed you, 2 days after that, and your money is going to get transferred to me. It's not unlike a specific trust that you have in Canada that is doing basically the same thing. And if you want to just have the price tracking of silver, that's what a speculator does in silver without taking delivery. All right. So, but at the first start of delivery, that person, that speculator, that long speculator that wanted to participate in what silver does, whether it goes up or down, that long, okay, he needs to roll or get out, either cover means getting out of his existing contract. If it was July, he did that before yesterday or before yesterday's end. And if it's the December contract, he has until the last business day of November. Otherwise, he has the exposure to the price of silver between the day he buys it and the day he covers or liquidates his contract. So I wanted to, I guess, just reinforce to listener viewers that a COMEX futures contract, it's not voodoo. It's not, there's nothing wrong. It's government regulated. It's there to help three types of traders either protect a profit or a margin or ensure or increase a margin or a profit. The speculators, they're in it for profit. They're not in it for loss. The hedgers are in it to protect profits. The commercial bullion bank, he's in it to affect delivery to somebody because he's got the positive coming in from the mine. He needs to take the positive because that's how the commercial bullion bank makes their money. They buy it from on one hand and they sell it on the other hand. So they make two transactions. It gets them in possession and then it gets them in possession of cash. That's the delivery side. Mm-hmm. So there's no voodoo. There's nothing mysterious about it. It's just that it seems like it's falsely understood because somebody's brother or aunt or brother-in-law told them some falsehood, and they don't quite have it right in some cases. Mm-hmm. Some cases they have it right. I'm here to try and help and clear up, misinformation or disinformation that's put out by people that are adverse to futures. It's just an asset class. It's a trade vehicle. Is all it is.
And like you say, it does have a purpose. And I appreciate you, spending the time with us to try and clear this up. So if we do see a possible default, in that case, there is a force majeure clause that is enacted, right? So what happens if you do end up in a force majeure situation? What price is that contract settled at?
It has not happened. I believe it did happen in one contract a while back, years back, and I forget if it was platinum or palladium. It may have happened.
Okay.
The force majeure is in case something happens, and let's call it an act of God. Okay. And let's say that the act of God might be what I would consider now. We used to have trading pits, and we don't really have the pits anymore. I was going to say that the building fell down and wrecked the pit. Okay. But now we have a series of computer banks. So I could say that really what may happen is that there was an electronic hack, might be a speculative idea that would cause the trading to cease and desist. And at that point, it would be my opinion. I'm not talking from experience here because I don't have the experience of going through a force majeure, but there is force majeure all the time in delivery of crude oil to a trade because maybe a hurricane stops the production of the crude or something like that. All right. But let's say that there was an electronic hack. It happened a while ago in the electric grid, I believe, someplace that afforded some mispricing of natural gas. I think it was in January or February in Texas. Okay. Their grid went down. So if something like that happened, it would appear to me that the CME's exchange, that they own the COMEX exchange, that the COMEX exchange, they might have a board of governors that they would make a ruling. And they might make a ruling to honor delivery, maybe at the last fix that we had, the last close, maybe, or the opening, if it happened during the day at the opening. I don't have a correct, educated guess for you other than we'll have to wait and see. For a force majeure, it has not happened. It has not affected delivery in gold and silver that I'm aware of since I started. I started in 1986.
Mm-hmm. So, Jim, how could we actually get a short squeeze in silver futures? Could this actually happen?
I think a short squeeze in silver futures, we had a little bit of a short squeeze in physical in this several months back with this Wall Street Reddit group that kind of banded together, and they tried to incur all their members or ensure that all their members went out and bought physical silver, and they might have bought coins or eagles, maple leafs, bars, whatever they could find. There's another term, silver rounds, generic silver rounds. That caused the price. It did cause the price short term on the futures exchange to go up. And it may be because we've never seen it before. But that first week of February, the high on the silver on the front month futures was probably the March contract at that time was $30 and change. Let's call it $30.30. Well, that it ran up quickly and it came down quickly. And then shortly after that, it went down, and it actually went down a few cents under $24, rings a bell. in the succeeding trading from that February time period. So in answer to your question, I think short squeeze is the wrong term for futures, because futures right now, we see the amount of open interest for the current month, okay? You would have to have that happen. You'd have to have a much larger demand for successive months, I think, to deplete not only registered but eligible stocks. So we get those totals. It's about the total now, Tom. It's over 300 million ounces. All right. So we'd have to have significant delivery demand, and it's no small feat, because as the price goes higher, the delivery demand costs more. You know, at $30, it's $150,000 a contract. At $60, it's going to be $300,000 a contract of cash. No small number for 5,000 ounces. All right. So it can happen. I'm not going to say it can't happen, but I think that what they did, the Wall Street trader, what they incurred to themselves a little bit of the wrath of God, in that each successive ounce they're buying now, they're paying a much higher premium for from their online or their corner coin dealer. And you might be seeing silver futures delivery demand higher, because it's the lowest price silver in America. So those sharp guys are buying, 5 1,000 ounce bars, and maybe one guy is standing for delivery and splitting it with 3 of his buddies. I don't know what they're doing, but I think that my personal opinion is that silver is very low in its price scale right now, in its price point, and silver has a long, long way to go up. I think that the bullion banks, they're happy to make their mark per 5,000 ounce contract, and that's why I think you see selling that happens when the price goes higher. They have a natural instinct to sell, because they've got, if my guess is educated enough, they've got 400 million ounces of silver that comes in every year that they need to deliver, they need to sell, move, because that, closes the other side of the trade. They bought it from the mine. They need to sell it to a speculator or an industry, and that closes the transaction on those particular ounces. I think silver has a long way to go upside. I'm not sure that you're going to see a silver squeeze in futures anytime soon. I think we can see an increase in the rate of silver and an increase in the price of gold soon. Soon meaning in the next quarter, in the next 2 quarters. I think we could be sharply higher. And my opinion there, Tom, is based on what governments around the world are doing. They're printing excess amounts of money, bonds, things like that, and the central banks in some overseas central banks are buying gold to get ahead of it, because mainly you might, if you Googled or if you were able to search out the Central Bank of China and the Central Bank of Russia, you will see that both central banks have increased their gold holdings over the last 12 to 24 calendar months. And I think they're getting ready. I think they've got some more foresight than maybe our central bank in the U.S. has. Although our central bank in the U.S., our Treasury has 8,100 tons of gold in their reserves. So they've got some, but they've not been adding. It'd be nice if they were adding. Our listener viewers that are watching right now, you can add right now, and you can start your own little, gold.
Your own central bank.
Your own insurance policy. Exactly right, Tom. And they can do that easily by calling one of the online dealers, coin dealers. You can search them out, or they can look on Twitter. You can search out coin dealers, or, there's providers of metal, physical metal for cash. That's their business model, and you can start your own savings plan. My own little meme is that, silver is a very good savings account for you, and you can let silver work hard for you and make money, increase your net worth and get a raise by using physical silver.
And you were saying yesterday to me that once the price of silver kind of gathers some steam, it can move really quickly, right?
That's my opinion. I believe that there is a natural resistance point on the chart that we've seen now the last 6 months. It's around $30 to $32. We didn't get near the $32, but I think $32 to $34 gets taken out. I think that there's a level where some of these short banks that are short, where they will protect their losses as well. And they may need to cover some of their shorts if we start affecting or start seeing $31, $32, $33, $34 silver. And we might see a quick increase. That happened in 2011. We got to $22, $24, and it was in short notice, we got up near $50. I think it was in a matter of like 8 or 9 months in the year 2010, 2011. Excellent. So it's a technical indication. Technical just means it's chart watchers are watching as we go through resistance levels or support levels. A little tip might be if you want to buy near a support, and if you want to put a stop loss when we're near resistance to protect yourself, and then buy it on a dip again. And you can do that over and over again. If you're just a straight hoarder or holder for silver, cash silver, that's not going to work for you. It will work in a silver futures contract, but otherwise you want to buy as much as you can when somebody affects the price to go down $2 or $4 in silver, like it has since February. I think now is a great time to be buying silver.
Excellent, Jim. Is there anything else you'd like to share with our audience before we wrap up here?
No, Tom, I think that's about it. I wanted to thank every viewer, listener that listens and that views this. And if they've got, some questions, if you want to share my Twitter handle with folks, they can write me and I will do my best to answer their question. If I don't know their question, I will find out the answer to the question and get back to them. I've got a fair amount of experience in it. And I'm just, my goal here is to try and set some of the misnomers straight, the falsehoods, try and lend some truth to how it works.
Excellent, Jim. And of course, your Twitter address is at Jim Sun, JimSunComm, and the number 1. Right. We'll put it in the show notes as well.
At JimSunComm1. That's correct. Perfect. Thank you very, very much. I really appreciate the opportunity to visit with you and to maybe help a viewer or a listener in their pursuit of finding out about futures.
Well, I really appreciate your time as well, Jim, and sharing your knowledge with us. I hope it does help some people and like you say, help clear up some of the let's say misunderstood information out there. I also really want to thank again Nate Fisher. Go check out their YouTube channel over at The Financial Enthusiasts. They just started their YouTube channel. They're more bite-sized pieces than our hour 15-minute conversation than we just had here. But absolutely go check out Jim and Nate. Thanks so much for your time, Jim.
Thank you very much.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.